Hello, I'm Jay Hirsch, Director of Administration of Columbia's ERM program. I'd like to welcome you to today's panel, Credit Risk Evolution in the Current Pandemic and Beyond. Throughout the event, you may post any questions you have using the QA feature at the bottom of the screen. Questions will be answered at the end of the panel. I'd like to tell you about some exciting events we have coming up. On March 18th is our next panel on the future of compliance and risk management in banking. On all Thursdays, we have our mindfulness seminars. On Fridays, we have our coding seminars. And on Saturdays, we have our IQRM seminars. On March 22 is our next CRO Spotlight Series, this one featuring Amanda Norton of Wells Fargo. On April 1st, we have our next panel featuring our alumni, and we have two more coffee and conversation networking events. And now I'd like to introduce today's moderator, Bob Kostakopoulos, Deputy Academic Director and Lecturer of the ERM program. Bob?
Thank you, Jay. Greetings to one and all. Welcome to today's panel. My name is Bob Kostakopoulos, Deputy Academic Director and Lecturer in the ERM program. I'm so pleased to moderate this panel with four successful practitioners from global banks, a top-notch commercial lender, and a top-notch consultancy firm to systemically important financial institutions. So without further ado, and by way of starting off our discussion, I ask them, Daniel, Chris, and Samir to kindly introduce themselves and briefly talk about their successful journey in the field of risk. Erdem.
Hello, hi Bob, thank you. Hello everybody, and good morning. And hopefully we will have a productive conversation over the next hour. About myself, currently I'm working at UBS. As you know, it's a Swiss bank, and a lot of billionaires put their money there. It's known as big wealth manager. There I'm managing a team of developers, mostly related to PD, probability of default, LGD, loss given default, and EAD, exposure at default models. So as you know, PD, LGD, and EAD, if you multiply these three numbers, you get something known as expected loss. And then this relates to the capital requirement of a firm. So for example, stress testing, you want the loss not to be greater than capital. So when you are doing the stress testing exercise, which is actually extreme case of unexpected loss, these models become important. So banks' capital requirements are affected, and whether they can pay dividends or not, or capital plans, these all depend on these numbers, basically. So in my current role, I interact with underwriters, which lend money basically to big corporations, for example. And credit officers work with underwriters, right? They are looking at certain reports, looking at details of the company, financials, leverage, liquidity. So in real life, how lending happens. And validation, there is a validation function. I don't know if you know SR 11.7 or different regulations require banks to have their models, but also some internal check on these models. And senior management of the bank. I work and also with regulators. We work closely. So developing a model is not enough. Not only you have to develop it according to some regulation and rules, but constantly you have to maintain these models. And if there are any issues, fix these issues. Right? So it's an ongoing process. Before my current role, I have been at UBS more than 2 years now. Before my current role, I was at the Central Bank of the US, the Federal Reserve Bank of the New York branch of the Federal Reserve Bank, where I was going to different exams, including the stress test, model risk exams, or Basel exams. So I was actually on the other side of the table. Now I'm developing models, but before I was validating those models, basically, or examining the banks. And before that, I was actually an assistant professor of finance. I received a PhD in financial economics. So I was at the Fed about 3 years, a bit more than 3 years. And before that, I was in academics. I was doing research. I was teaching finance courses, investments, introduction to finance, money banking, this type of courses. And I have some research and publications in the area of sovereign risk. So how the government bonds are rated and what are important factors that go into these ratings. And yep, I'm originally from Turkey, did my undergraduate in Istanbul. So that's all about myself. If you have any questions later, I can answer. Thank you, Bob.
Thank you, Adam. Daniel?
Hi, my name is Dan Cope, partner in our New York office at Oliver Wyman. And I guess, Bob, thanks for the intro and asking about my success journey. It's very flattering. I'll use that in the future. But I've been at the firm for about 15 years, focused on a variety of different quantitative topics. And I think sort of started when I first joined the firm in the mid 2000s, focused very much on quantitative topics, a lot of the same things as Erdem on PD, LGD, Basel, these sort of things. And then over the years, certainly as the industry started to focus on stress testing, so did I. And then I've also worked with a lot of our clients on bringing quantitative analysis to new topics. So things like, how to build underwriting models for new products or things like that, or customer segmentation models, areas where people hadn't necessarily applied quantitative methods. And so that's all about me.
That's great. Thank you so much, Dan. Chris.
Good morning. My name is Chris Mann. I work at MUFG Bank. A lot of people may not know MUFG Bank. It's, after the Chinese banks, the third largest bank in the world. In the US, we have a large branch system, and we own Union Bank in California. My current job is wholesale modeling for credit. I've got over 20 years of experience in credit research and modeling, and I've touched basically every type of credit risk that I know of, at least in the banks. Currently, my team does the EAD, PD, and LGD models, but we also do stress testing models. That basically takes a bunch of scenarios, usually given to us by the Federal Reserve, and tries to forecast what our potential losses going forward could be. In the past, I was on the front line doing loan approvals for large financial companies, meaning to say we were doing products to those financial companies, not that I was at multiple financial companies. Before that, I was at Moody's, where I was in their internal consulting group. We worked with the credit analysts to try to find new ways to improve how they did their business. During the Great Recession in 2007 through 2009, I actually went into the credit rating groups and did their analysis of all the real estate derivatives like RMBS, residential mortgage-backed securities, CLOs, and CDOs. I've got my PhD in finance from NYU. I moved over there from physics because I saw that finance had beautiful math, and I still love studying physics, but finance was very exciting at the time, still is, to be honest. And that's about me, Bob.
Thank you so much, Chris. And of course, Chris is a lecturer in our program, and we are very proud to have him. Samir, please.
Thank you, Bob. Good morning, everyone. I went to Boston College and did my master's in finance, and came out and joined GE's corporate audit staff, got deeper into the finance. And after I graduated from that program, I came into the credit side, the credit risk management. I started in consumer finance, but very soon moved to the commercial side where I have stayed all along. I have been through the three different segments of the credit management: underwriting, portfolio management, and workout. Done probably $14-15 billion worth of underwriting across most of the industry sectors, mostly middle cap companies to small caps, some large caps. I have also managed across all sectors and most of the time on own loans that I underwrote as well as some others. And the record has been good so far, seen through cycles, the financial cycle in 2000 and then 2009, and we are now here. Never lost a penny, always recovered what I underwrote. And I have also done the workout last few years, again, across most of the sectors. Thank you.
Thank you, Samir. As you see, our panelists and the roles are very similar to the roles of essential workers in the pandemic. These are the people who fight in the trenches to keep their institutions navigating the risk minefield. So I know the markets are thankful to them, and so is the economy. So kudos to you. All right, so the question is, have credit risk management processes been affected by the pandemic, and what might be some examples? Any of these processes might survive the pandemic, and then we have a subsidiary question that is how have the outcomes been? What are the effects of the pandemic, and where is the risk more significant currently, if not in risk? So we'd like to start with Samir and then go to Daniel and Chris. Samir.
Thank you, Bob. So I think I'll start with my position in terms of what has not changed and what has survived. During pandemic, of course, most of us have worked from home. At the start of March when lockdown happened, things have started changing, I would say, kind of November, December, January timeframe, depending on which sector you're looking at. And like I talked about what we do in the credit risk management, you start underwriting a loan, then you manage it. And when things go south, you go to problem loan, workout, restructuring, whatever you want to call it. So the first thing which was obvious, I guess everybody will see that, is as the market started turning, the anxiety levels went up, the surveillance or the watch of the loans started moving a little more intense. And when those things happen and you combine that with some real sign that are tied either to the industry, a sector, or a borrower, the oversight of workout team starts getting up. So as a natural consequence, if you think about the workload of the workout team within any institution, if they were managing, say, 40 loans, it starts gradually going up to 45, 50, 60, etc. To manage that workload, you need extra manpower. Either you hire from outside, but that is typically the cycles are temporary. So most institutions will try to find a way to align the needs of the work, in this case workout, to the workforce that they already have. And most institutions, again, have two different ways to do that. One is move some of the frontline teams, which is underwriting and portfolio, to the workout team. Second, use them temporarily. Or third, depute your frontline teams in the guidance of workout team to continue to do what they are doing, but with an additional insight. And all those processes, if you go and look at the cycle wise, they start at the beginning of the cycle and they typically end at the end of the cycle. The question always is, in terms of these processes, how quickly you ramp up the surveillance of the credit. So before credit goes south or before credit needs extra monitoring, you have the resources there. And in most cases, institutions are, I think, well equipped in these cases. They have seen the past. And most institutions, I would say, based on what we have heard in the market, got time in this case to prepare, even though the levels of anxieties or levels of the market in terms of the uncertainties went up pretty high. But those processes got strengthened and worked to the extent we know. I'll stop here for the team members to join.
Sure, I'll just jump in with two observations. I guess the first one is that at least so far, the credit outcomes have been relatively mild from the pandemic. I think, a combination of massive government stimulus, about which we're about to get another dose of, and it's a very different type of economic impact when you have a exogenous event like a pandemic, where there's a remaining underlying belief throughout all sectors of the economy, both the banking and the real economy, that there's nothing fundamentally wrong. There wasn't an over-leveraged crisis like there was last time or something like that. So I think that's had people holding their breath a little bit. And that said, I think the hit to GDP has been greater than the amount of stimulus. So you've got to imagine that there will be some losses on the banks at some point. I think the other point that I'd make is, especially at the start of this, and Samir mentioned sort of the staffing up and sort of rushing around to try and meet client needs at the beginning, led people both on sort of the retail side to do a lot of forbearance and other type of workout activities very, very quickly. Similarly, responding to the PPP loans that was sort of rolled out by the government over a weekend, and doing that all properly. So I think the ratio of credit risk in the system to sort of reputational or other types of risk and non-financial risk, where you could come under, banks may come under scrutiny for how they administered all of these programs and whether they were fair and these sorts of things later. I think the ratio is a bit different than it was in the past. Probably the non-financial side is bigger than it normally was, not necessarily bigger than the total amount of credit risk.
I would add quickly to what just Dan said, that in terms of what institutions do when cycles like this happen, economical onslaught, the front end, which is mostly engaged in underwriting, either slows down, looking at the concern and the credit risk concern in the market, or sometimes even pauses in some industry sector. Stop here.
So this is Chris, and I'll keep my comments short, seeing as I'm the third on this one, but I will add now, Samir mentioned that a lot of people would move over to Special Assets Division, or SAD, to help manage the distress in the portfolio. Daniel mentioned we haven't really seen much yet, though there's still large uncertainty around that. One thing I will mention is just operationally, the CARES Act and all the work around that led a lot of banks to pull people not just to SAD, but to the operational aspects of trying to manage these new government programs. And that led to a lot of risk in the background, with key positions not being covered. And so what I've seen is a lot of efforts to use RPA, I believe that's a robotic process, whatever, automation, and automation to cover for the large number of people that had to be pulled out for many months. And so that's going to be something, I think, as we come out of the pandemic, that these nascent efforts to automate the positions that were seen as overly manual will continue. So I'll stop there.
That's great. So Daniel called this execution risk, trying to execute all those programs and do it well. So that's that's wonderful. Okay. The next question is it's about models, credit risk management models. How have they performed? Any surprises? Any changes? Adjustments? Enhancements? And we'll go to Dan to lead, and then to Erdem and Chris. Dan.
Sure. I think when you think about credit risk models, there's sort of two sides to this. The first being sort of the underwriting and portfolio management, very close to the frontline side of things. And on that front, there's sort of a split between rank ordering versus absolute levels. And I think for the most part, the rank ordering ability of models has stood up. But the absolute level has not been particularly good, right? I think especially given all of the extraordinary government assistance, the models would say, particularly if they're incorporating macroeconomic factors, that things should be much worse than they actually have been. And I think you see that even more so on the stress testing or loss forecasting side of things, where the dependency of your business process on those macroeconomic factors and forecasts is even greater, because you're trying to forecast the total dollar losses, not just, you know, that Dan may be a worse borrower in this situation than Samir. So I think you have to think about those two dimensions, or maybe it's a 4-cell matrix, as consultants like to create. And so the rank ordering, I think, has stood up, but the absolute level has not performed very well at all.
Artem?
Yep, I agree with Dan. I just want to add a few things. I think if you look into models, some models are just for underwriting, in general, business as usual models. And in general, they are able to predict default well, 0 or 1 outcome. Or LGD models also have downturn LGD. You know, all of these are, I think, worked well in general. But I think one part that a lot of banks had problem, talking to my friends, was the CCAR models, because during the pandemic, some of the macro variables went to extreme levels, and this in history this was not observed in such a short amount of time. And because of these issues, they weren't calibrated to these extreme moves in a very short period. So a lot of the banks, I believe, especially related to stress testing, they kind of adjusted their models to be able to account for these extreme outcomes. I think that was one of the part that a lot of banks, a lot of models suffered. They kind of freaked out. Some of the models freaked out because there were some extreme values that the model didn't take as input. So, for example, they might adjust how they take the inputs, or whether they standardize these inputs, or binning these type of things. They might have to pay more attention. And I believe, yep, this was just a common problem to all banks. There are more details, but some info is confidential. But so this was one of the issue in the pandemic, that we had these extreme values that were never observed in history. For example, as you know, for 3 months, things didn't move, right? So a lot of the GDP numbers, right, is very extreme in some cases, GDP growth, for example. And one more thing I can add before I pass it is we have new data now, right? So the 2020 is a new data, and all of the models will include this period in their, when they develop these models, or when they do backtesting. So this will be some additional year of maybe crisis or stress period that a lot of regulators will look into what happened during this period, or even this year, maybe some of the lag effects of that to defaults. So last year and this year will be, I think, important years in model developing and backtesting. Yeah, thank you.
Great, thank you. Chris, you'd like to add something?
So I could talk for an hour here. So it's not just the CCAR models, but it's also the effect on CECL, which is how the banks do the reserving. I mean, yes, GDP dropped significantly, but the key variable that affected most models that I know of is unemployment rate. In the past, I mean, all these models are usually quarterly based. They're not monthly or yearly. And so it's a change over a quarter that matters. And in the second quarter of 2020, unemployment jumped from 4.5% to 13.5%. We'd never seen a jump anywhere near this. And so what we saw is that for those industries which were not that heavily dependent on unemployment rate, those models actually performed pretty well. But for all the rest, they went way beyond their bounds, forecasted losses, which were much higher than we expected given the government support. I will agree that we do have 2020, which is important, but I would say that 2020 is not data. 2020 is information, because the question that has to be, we'll talk about this later, I think, but the question has to be asked about that information is this information that will repeat in the future? Is it a one-time thing because it was so far an outlier? And you don't know how to incorporate it into your model. So at this point, we're still trying to figure that out.
Okay, that's a great insight from our panelists. In the interests of moving along, we'll proceed to the next question that has to do with what Chris just mentioned, which is how has the pandemic affected the implementation of CECL, current expected credit loss standards, and also how have the commercial and industrial loans, CRE, commercial real estate loans, and retail credit portfolios performed during the pandemic? Are there any subsector differences? And with that question, we'll go to Samir and then to Chris. Samir.
Thank you, Bob. So let's go back where this is started. Most of the regulations and changes start with some observation and what needs to be done as a corrective measure. So back in the last crisis, 2009 financial turmoil, observers saw that there is a disconnect between what companies were booking as reserve and what they could estimate based on the events unfolding in the market. And there was a disconnect. So a thought process went into it, and ultimately it took form of CECL, which was to replace ALLL. Adam talked earlier in terms of the expected loss, probability of loss, etc. On a most fundamental level, most institutions were using a multiplier, an expected loss probability of default for a borrower, multiplied by a loss given default and some factor, and you get what you call loss for the particular borrower. And similarly, you can aggregate in the model, you get ALLL. The problem that observers found with that was kind of based on an incurred model, and there was no necessarily adjustment if you are looking in the future, things like pandemic is happening, can you adjust those reserves? The adjustment mechanism was not there. So that's where CECL came in. It was to be implemented by around 2021, different timeframes depending on how big a institution you are, whether you're a small cap, big cap, and public entity or not. And pretty much everybody has weighed in on this by this time. Just to note, just before pandemic, the agencies that they call Federal Reserve, FDIC, OCC, the regulating agencies together, they had already talked about back in November, December timeframe of 19 to somehow delay, if possible, the implementation. Then the pandemic happened, of course, took form in February, March, and CARES Act inscribed in that is that delay the implementation until the end of 2020. And then somewhere around September 20, another agreement came together among the agencies where the transition has now been deferred from 3 to 5 years. So there are two aspects I'll talk about here. CECL implementation, whether institutions are prepared or not. And the second part is, in essence, when will it show effect on the books in terms of the real reserve? The concern has been from the creditor's perspective twofold, or two different sides, if you will. One part is simple. In terms of CECL implementation, once implemented fully, it will increase the amount of reserve by rough estimation is at least 50 to 80%. It could be double, some number, but definitely it will reserve. The second aspect of that is the other side of the coin is when these provisions go up, typically the concern here is, will the lending capability of the institution will go down because you are providing extra reserve. I link that to the pandemic situation. As we have seen in the market, there was a report today, the $237 billion odd reserves they had ballooned to during pandemic, because as the concern got up, anxiety level got up with the financial institutions, the reserves started piling up. And now people are realizing the economy did not turn as bad as it was expected in the beginning when the reserves were getting boosted in first, second, third quarter of 2020, and some reserves might get released. So that is a direct impact for you, what reserves, the role reserves play in the market, in the credit, and in terms of liquidity and providing the strength. The second part of this question is in terms of the impact on different sectors. I'll try to take 2, 3, 4 sectors very quickly and try to break them down from the creditor's perspective. So retail is the first sector that everybody would have seen by now, that it was immediately when the stores got shut down, the activity got shut down, they got immediate impact. So when you look at the retail sector on its own, you will see up. Restaurant is another one. They pretty much, if you're in New York City, you will see that the industry was decimated. What you need to look at then is on a credit risk perspective, bring it down, who survived, who did not, and what were the causes. And that is how you do the credit analysis. So retail sector for first, if you are a big brand name, if you had a channel for distribution that did not entirely rely on the store, which is online, which a lot of people had gone there, and if you have liquidity, if you have at least these three elements, you probably survived and you actually got there nearly intact by the end of the pandemic. When I say by the end of the pandemic, I don't want to predict pandemic is over. I'm saying at least last 11 month, 10 month you have, just to be clear. So take an example. Why do you need a big bank, a big retailer? What all you will need? We talked of liquidity, for example. Liquidity is gonna need, you will need there is for 2-3 reasons. One, you need to keep the suppliers there. Second, when the revenue is not coming in, you need to somehow fund those payrolls, fund those expenses that are fixed cost. And how that is funded is through the credit lines. And the credit line many times are drawn all the time because of working capital credit lines. Sometimes they are never drawn unless something like this happens. The flip side of that for the credit risk guys is when the credit lines do get drawn, a credit guy like me comes to the office next day very concerned what happened. What did we do and how did we do it now? And the reason for that concern is twofold. One, you are looking at the metrics that were there good until yesterday. When your funded amount was less, has suddenly gone up by some X dollars. And now you need to figure out how are you going to recover it when the time comes. And second, the company's ability or your borrower's ability is suddenly now restricted in the sense they have drawn the money. They're going to use it for what the needs are. The question is when the business needs continued liquidity, where is it going to come? And those concerns always are there. So retail we talked about in terms of who could survive based on the factors or not. Look at the restaurant industry. So if you are a single restaurant, if you are a sit-down restaurant, if you are a whatever XYZ, probably you had a very tough time. But if you break down the industry again by segments, full service, half service, quick service, a quick service will be the fast food, like McDonald's, Burger King, etc. Those guys, so long as they were managed well, they came back pretty good. In many cases, we know they came at almost like 100% level within the first 6 months. And the reason was the takeout, again, the channel for delivery to get to the customer. It was takeouts in some cases, which were 30, 40, 50%, got up to 80 or 90%. So the shortfall was roughly 10% only. Or in some cases, even that was made up because people during pandemic were not venturing out more, so they were buying more. So your revenue necessarily did not get affected. So that is the differentiation in credit sides among the restaurants, how different levels of survive. Come to the hotels. Again, if you do this dissemination in terms of, segmentation, how you're looking at it, the smaller hotels with very little leeway to turn around or rely on the liquidity otherwise did suffer. The hotel occupation, for example, which typically used to last like 65, 66% occupancy, at the worst level in US went down to 22% occupancy, which means the revenue nearly came to a halt. But you still need to service, and hotels are mostly service based in this case. Now, you need to again segment it, like I said earlier, smaller hotel, brand name hotels, or in the purpose of what you are doing. Purpose-wise, if you go from the back end, if the hotel is primarily relying on the conventions, hundreds of room books for the convention, you are pretty much decimated. That market was not there in 2020, likely not be there in 2021. Without prediction, it is going to take time, maybe 2022 before the conventional market picks up. So those hotels are very deeply affected. Second part, the big brand name hotels, they survived a bit better because of, again, the items we talked earlier. They had some liquidity among the pool. They had some better resources to share, and they had a longer runway to survive in the same time. A good example is in the Wall Street today, extended stay that got bought even in this market, low utilization, there is a deal being made. And the reason is very simple. In this case, intuitive also. So if me and my wife need to go take advantage of working from home in pandemic, you may not want the same luxury like any other hotel will provide during for comfort. What you're looking for is, if both of you are working, 2 separate rooms, some kind of kitchenette because restaurant may not be open. Extended stay is one of them that is providing that. So I'm not boosting for them. I'm just saying usage-wise, if you see things change, the segments work very, very differently. The subsectors work very differently. The last one I'll touch is entertainment sector. So if you again dive down in the entertainment sector, film industry, for example, theaters were shut down. Producers who were making film, for whom we are giving credit as our borrowers, some of them did good, some not. The producer that did good or at least survived were the ones who had alternate channel, meaning again, video on demand, releases online, etc. Who could do that, they did okay. In some cases, at least, those were the guys who were making low budget films. Let's call it around 5 million or less than 50 million. Those were not the guys who were making billion-dollar films who could recoup the money just by online. So that is a whole gamut, I would say, here, and I'll stop.
Okay, Chris?
All right. I will try to keep mine to about 20 seconds, Bob. So the 2 things I would like to bring up are, one, the peer-to-peer lending fintechs are getting hammered. If you think about those companies, they're typically companies where people who did not have access to banking went to get loans, which means their credit quality probably was not as good as you would see at a typical bank. Therefore, the second thing I will say, in commercial real estate, we know the areas that are getting hammered. One thing that is surprising there for us is that multifamily, basically commercial real estate apartment complexes, they're actually doing quite well. And we're not sure why, because we expected much worse in this area. Anyway, I'm going to stop right there. There's a lot more that could be said.
That's that's great. So credit risk is obviously very important, and as Merton taught us many years ago, some sectors assets, someone else, some other sectors liabilities. So you get those non-linear relationships there that give us complex and compound effects. Next question is, in terms of scenarios, what are some plausible scenarios, including worst case scenario, about the recovery and the end of the pandemic? And with that, we'll go to Chris and then to Samir.
So what I would like to do is just call out a few basic points right now. So in New York in December, 15% of all renters were unable to make their rent payments. This is an issue across the US. There's an estimate right now that there are millions of renters who have not been paying and currently have a backlog of over $50 billion in debt to their landlords, right? Because they haven't been paying. The moratorium is now extended to March 30th. It probably will be extended, I think in New York itself, it's extended to June already. Part of Trump's package, the CARES package, there's 25 billion allocated for renters. In the new Biden package, there's another 25 billion. So 50 billion against 50 billion. Now, in the mortgage area, the best case scenario is that money actually gets to the renters and actually they're able to make their payments. The landlords come out better because the landlords aren't receiving money. They owe, there's a lot of landlords that are facing eviction because they can't pay because they're not receiving their income. So the best case is that money flows through. The worst case is we live in a country that's highly bureaucratic and that money may or may not make it to the end people. We could see a mortgage Armageddon or a renter Armageddon, a full real estate Armageddon once all these government programs subside. And that worries me. I mean, I don't expect that, but it's not negligible. That really could happen. And that could tip us over into a new recession because it's always real estate that tips us over. The second thing I'll talk about is cities. We don't know what's going to happen to the cities. Now, if you look at Midtown Manhattan, it's a ghost town. When you go there, there's nobody there except for homeless people. When you look at the residential areas, they're still thriving. There's restaurants, there's people out all over the place. The cities are still thriving, but we're learning that we don't need offices anymore. It's very likely that the amount of offices in New York will decrease and the amount of residential area will increase. We have no idea. Worst case scenario is that all these office companies, the REITs, they all lose money and that the cities get hollowed out. And again, that could lead to another recession as we have to dig out of that wealth gap.
Yes, very true. Of course, we have 9/11 to fall back on. A lot of people left New York City at that time in the aftermath of that. And it took about 3 years for people to actually come back. Samir.
Actually, before you go into Samir, I want to say
Okay.
I do agree that if nothing else, the young want to be in the cities for all of the events and the other people. So that's good.
Yes, that's great news. Samir.
Sure. So US economy is 2/3 reliance on the consumer spending. So that is directly tied to how quickly consumers get on the road and start doing it, tied to the vaccination, which is ramping up. So by summer, if you have fully vaccinated or whatever scenario you're looking at, that is gonna drive the consumer side and GDP will be okay. The other 1/3, which is not, is also tied to the global economy. So you are relying, especially in the supply chain for manufacturers, on that part of the world. That has to work. It is falling behind at the moment in the sense, or it is not falling behind is the wrong word. It is lacking in coming to normal because of vaccination, etc. So a combination of these two factors and what Dan said earlier in terms of the stimulus, extra money or helicopter money that is coming in the society, these three are gonna drive where the scenarios will fold. The upside and downside, me being a risk guy, let me go to the negative side first. There is a possibility that I mentioned earlier, for example, convention. If the convention market, just for example, illustration, does not come back even by 2022 end, it could have effect similarly. And same thing, if the strain of virus goes different, you could have a similar, another cycle of lesser activity. And those are pretty bleak scenarios. The upside is something one of the teammates can talk about. Thank you.
I'll just mention on this one, it's been a very extended period, a year now, of a lot of different scenarios, all of which are very plausible, right? In the last recession, there was certainly a period of uncertainty at the beginning, particularly on sort of very micro questions, which bank is going to survive, which isn't. And if you're a shareholder in one or a debt holder in another, it matters a lot to you which is which. But the overall course of what's going to happen was fairly clear. There was a bubble that was popping. Some pain needed to be absorbed, and it would be, and it was a question of exactly who. Here, you don't have that clarity, right? So, we're getting vaccinated. Everything could be on the upswing, and there's all this stimulus, and we could have a really booming economy in the latter half of this year and next. Or we could get all vaccinated, things could look great. And then sometime in the second half of next year, new strains come about, it's wintertime again, and it's all, the history repeating, right? So you can invent a lot of very divergent scenarios and over the course of 2 years, which is not something that we've seen before.
Okay, that was a full discussion here. Thank you so much. I think we touched on the next question about how regulators enforced stress testing, CCAR, comprehensive capital analysis and review, during the pandemic, and what the stress testing results have been during the pandemic. If we can have some short answers here so that we can move ahead. Erdem, and then Daniel, and then Chris.
Hello again. So in terms of time, I want to just keep it short. I think we have 4 or 5 questions more and about 50 minutes left. So as you know, CCAR was administered starting after 2008 crisis. This exercise started, and for the big banks, administered once a year. Usually, the scenarios, the Federal Reserve gives these scenarios in February, and the bank at the end of February, and the banks look at their results, try to run these scenarios in their models in some March, and give the results to the Federal Reserve, right? So these scenarios might change every year. For example, I think this year, the CCAR 2021, actually, I think the scenarios came 2 weeks ago. And then there is a special emphasis on, for example, CRE market, CRE loans, corporate debt market, special emphasis on unemployment. It's going from 4% to 11% in these 9 quarters. And for example, a couple of years ago, emphasis was on oil prices, how much oil prices can go down, because around 2016, 17, you have a lot of bankruptcies related to the price of oil, energy companies. So every year this changes. This year, how they are enforced is actually in Trump administration, there was some discussion about whether to do the stress test every other year for the large banks. So instead of every year, they were suggesting maybe we should do it every other year, sometime in 2019. But this year, last year, it's been realized that actually once a year might not be enough last year, right? So last year, not only did the February, March one, but also November, December, there was a second stress test to incorporate the impact of COVID. So I would say this year we had 2 stress tests, and most of the banks, I think all of the banks passed, but as I mentioned, there were some issues. Most of the banks have issues about, as Chris mentioned, unemployment or other macro factors. So they have to adjust their models. But at the end, as also Samir mentioned, there were enough capital. A lot of I think on average about 12% capital ratio. In stress, it was dropped to 10%, but it was still sufficient. I think reserves were sufficient. So all the banks were prepared for this. Thanks to maybe this stress testing, all of these exercises, all the banks looked very prepared. Yep.
Great. That's certainly not a result of the great financial crisis of 2008 and Dodd-Frank in 2011. Dan, I think you may have some comments here.
Yeah, I'll just mention, I guess, some strengths and weaknesses of the system that we have here, right? So some strengths are the nimbleness. So when the Fed said, we want you to do an extra one this year, banks were able to do it, right? If you rewind to 2009, the SCAP, the sort of first version of CCAR, the Fed says, surprise, we're going to do a stress test, and everybody runs around and doesn't really have a good way of accomplishing that, whereas now they do. And then the other point Erdem mentioned is, that system has forced the banks to hold a lot of capital despite the very benign economic environment that we've been in, and that served us well. So I would say those are sort of 2 strengths. Weaknesses, and this was one that I think everyone was conscious of, and it came to fruition quite in an extreme way, is that the models that everyone's are using are effectively calibrated to one data point, being the last recession. And there's a lot of underlying data underneath that, but it was a recession of one type, led by a bubble in real estate. And there are certainly other types. The early 2000 recession was not like that. Stagflation recession much longer ago was a very different type. This one is a even more unusual type, and it just highlights the weakness of the system that we're using. That when a new recession flavor comes about, there'll have to be a lot of overlays that are not sort of based in the very detailed modeling that everyone has been doing.
So it's not enough to just say the unemployment rate is going to jump to 14%. It depends also on the underlying causes of the unemployment rate rising to that level. Chris, any brief comments on this?
You know, Bob, I think for time I can pass this time.
Okay, thank you, sir. This is important in the sense that this pandemic is going to give us a lot of data or information, as Chris called it. Only a data analyst would make that distinction. So how do we make the best use of the data that we are going to be getting from this pandemic, this deep drop in economic activity, that much stimulus that has come from the monetary policy side and from the fiscal side. Chris, what do you think? And then Dan.
Right. So what did we really learn? I mean, we've been talking about this, that the models blew up in the second quarter of 2020 because the macroeconomic variables, or MEVs, just went to such extreme values. The models can only forecast really in the realm of the data that they were trained on, and to a certain extent right around the edges, right? And after the Great Recession, we had assumed that we saw the largest spikes that we would probably see. And so we assumed that the models would be okay to forecast even near those edges or a little bit beyond. And what we saw was that there's a huge amount of nonlinearity. Once you go past those levels, right, the government stepped in and provided stimulus in ways that the models couldn't predict. And that's why I call it information, because we could try to fit the models to this nonlinearity. The problem being it's only one point. And I think we will try to do that. But more to the point, there's two things that are going to come out of this. One is the information that we have to be better at modeling outside the range of our core data sets. We're not sure what we're going to do with 2020, whether that will be a core data set or a point to test against, right? There are statistical means to do this. There's extreme value calculations that we could use, but I'm not sure even those will work very well, because the key thing that we're seeing through this process is not that we have new data, it's that the uncertainty in the system is increasing, right? So we thought the Great Recession was the worst. It was the worst we'd seen since the Great Depression in the 1930s. Now we have this, which is even worse, and things keep coming, right? So we have the hurricanes that are increasing in power. Right now, a lot of the banks are dealing with the energy sector in Texas, which just had the worst freeze in decades. There have already been 2 major bankruptcies there. So I think one is Brosco and the other, I forget the name, and we expect more. So somehow we're going to have to incorporate this concept of additional volatility in the results from our models. We already have some methods for that, but we're going to have to expand the boundaries on that. But again, I call this information because it's not yet data. It's a data point, and we're probably going to get more of these, unfortunately, going forward. I'm going to keep this short, Bob, because I know we're running out of time.
All right, thank you, Chris, for this deep answer. Dan, any
Sure.
comments?
Yeah, I think if I think back to 2008, we saw a step change in the level of granularity and modeling that people were able to accomplish, both because of sort of data capture and computing power. And I think you've got that here as well, right? We've probably got an increased data capture and an increase in computing power. And so some of the challenges that Chris raised of this being a very exogenous event, a very atypical type of recession, but it did provide a lot of natural experiments where you could say, okay, what if we just turn off parts of the economy? What happens, right? What if we provide stimulus in certain sectors and not others? And so I think the way you translate a lot of this information into data is to start modeling and understanding those very granular things, but that requires a lot of data capture and a lot of data computational power, which we have more of now, but a lot of thinking will have to go into how do you harness all of that.
Most definitely, and just the checks that the IRS sent out in 2020 and the ones that are going out this year, that was an experiment that was basically tried for the first time. And apparently that worked. So the government people were surprised that direct payments may be the way to go to give a quick injection into the economy. All right, so I'd like to jump to the lightning round question, which has to do what you think about what is critical, a critical area in credit risk about which you're most concerned. And let's do that briefly, and let's do it alphabetically. Erdem?
Okay, the most important part in credit risk, I think it's, as we discussed before, it's matured. But I would say going forward, I expect things like in cyberspace, that we might have issues like with fintech, new companies coming in, Bitcoin coming in, all of these things. I think this is the biggest risk that if we suffer a big cyber attack or some issue in the more fintech space, that might go into the bigger system and create issues.
Okay, thank you. Dan?
Sure. I think the biggest credit risk remains that, the size of the stimulus is smaller than the hole in GDP. And somewhere that's going to work out. And I don't think we have a good sense of where that's going to be yet. And so it's the unknown of that. I think there's a lot of suspicion around real estate and other places that Chris brought up. For example, you could imagine some of the personal loans as well that are unsecured, but we'll just have to see.
Okay, Chris?
All right, I'll just go back to real estate. Right now, some are saying that we have a real estate bubble, despite the fact that there's so much weakness in that sector. That's a big concern right now for me. Obviously, there's other things like, as Erdem said, for scenarios.
Okay, Samir?
Sorry. So the biggest thing that concerns me from the creditor's perspective, you can say like losing the sleep, is to think, have we stress tested enough for every underwriting? And I'll give a very simple illustration here. Chris and Dan had talked about complication of modeling and the data and how it gets in. It starts, if you look about the single borrower, have you tested a scenario and have you stressed this enough? Just to be clear, we can never eliminate the risk. We are the credit risk guy, we manage it. So a pandemic like this event again will also not be eliminated by whatever you do. The question is how stressed you have done your underwriting that provides you a scenario, at least a decent cushion to withstand what is going to come. Stop here.
Okay, thank you. If we can put in a question, actually a request for you to offer career advice to students. Let's start with Dan.
Sure. I guess I would say, think about what is the most important challenge facing the banking sector and focus on solving that challenge. If you can help your institution that you're working for do that, that would be, my advice.
Okay, Chris?
So the banking sector is consolidating rapidly. In 1981, there were more than 13,800 banks. Today, there's only 5,000 banks. We lose about 2,000 banks a year. Despite this, the number of people in the banking sector continues to increase. That means things are becoming more centrally organized and process oriented. Despite that, we are about to go through a vast amount of change. So my recommendation is to expect to go into a career where you are constantly changing things and not where you're going to fulfill a role. That's the only thing I would say.
Okay, resilience. Erdem?
Yes, I agree with Chris. We have the big banking sector, but that's not only the place that you can find jobs. You can go into hedge funds, insurance, private equity, or different sectors where they also do, credit risk management or, risk functions. So we try to look at all different sectors and see whether, you can find opportunities there. My career advice in general would be first decide on whether you want to be a credit officer or underwriter, or whether you want to be a quant. But underwriter will be more like maybe Samir, more in underwriting business, real life. Quant will be more with data science. So first decide on this, which one you want to be. And then depending on that, build on skills. So for a credit officer, maybe more detail oriented, more documentation, more experience in business, who to lend, who not to lend. And for the quant part, you will need some to learn some programming, like Python or R. This would be important skill if you want to do the quant part, quant direction. Thank you.
Thank you. Samir, briefly, we are a minute over our allotted time, but please go ahead.
Yeah, I'll add to just once you are in, based on the advice of my panel teammates here. So raise your hand every time a new project comes, anything on your table, raise your hand, number one. And as a soft skill, always manage your reactions. Be pleasant. Don't let it show if you're feeling skeptical, at least, Thank you.
Thank you, Samir. Thank you, panelists, for this wonderful and informative, most informative panel. I think that concludes our panel this morning, and my thanks to all of you. Thank you.
Thank you, everyone.
Thank you.